Hey, how's it going, everyone? Dividend stocks nobody is talking about. Just like how no one ought to talk about my receding hairline when they meet me. A dividend investing strategy. I don't know about you, but to me, it seems as if all of the popular dividend stocks and industries are near their 52-week highs, and buying a stock while it's at its highest price ever seems kind of counterintuitive for a value investor. However, there are a few industries that are taking a 10 rounds with Mike Tyson type of beating right now, such as REITs, utilities, consumer packaged goods, restaurants, and clothing companies. Sometimes, due to macroeconomic conditions, certain industries could be soaring and other times struggling. My train of thought is to buy the name brand, high quality companies while they're facing slight headwinds because more often than not, I can grab them on a discount. A good business with solid operational fundamentals, a proven dividend track record, and economic moat will almost always recover. Eventually, that is. And by the way, if you're a fan of the NFL, then you would have laughed at me 10 years ago when I told you that the Cleveland Browns and Buffalo Bills would eventually become playoff contenders. And if you don't follow the NFL, then all you have to know is that Cleveland and Buffalo have been disgusting trash for the better part of the last 2 decades. On the other hand, a lot of young startups that went public during the pandemic are struggling, and they're going through a deep pile of cat poop for good reason. And that's because they're burning through cash without turning a profit, and taking out loans can only keep them alive for so long. I'm talking about Joby Aviation, Rivian, Ginkgo Bioworks, WeWork, Bird e-scooters, and the list goes on and on. These companies, much like those in the dot-com bubble, will dissolve, disappear, or get acquired by a bigger fish in the sea. To that list of big risk and big reward investments, I say no thanks. As a dividend growth and value investor, I am more interested in proven companies that are here today and will be here tomorrow. Brand names that people recognize, products that people use every day, and businesses that I can invest into knowing they will pay a consistent, reliable dividend. A dividend yield I can look forward to as passive income. And the most important factor, undervaluation from the market because they're bearish for the time being. I've got patience, so if I can pick them up on clearance, I'm picking them up. Just like how I'm picking up my life after being depressed for the past 5 years. This is a true story, and I actually feel happy with my life now. Anyways, this is not a therapy session, so the stocks in question: Campbell Soup Company, Crown Castle Cell Tower REIT, General Mills, Hormel, and Marriott Vacations Worldwide. So how will this video unfold? First, I'm going to give a speedy blind date introduction to the company and their business model. Speaking of which, has anyone here actually been on a blind date before? Well, I have, and it was the most awkward, I never want to do it again experience of my life. And that was well over 10 years ago. And I hope that individual is doing well. I wish nothing but the best for them. And then, of course, we'll take a look at their dividend profile and history. And finally, we will look at their past performance. And a part of that will be the year-over-year CAGR. And quite frankly, we could spend 2 hours together doing a deep dive, going through every financial line item in their balance sheet and going over all of their numbers. However, the total return will tell us holistically if they did well or not. So for time's sakes, this is how we will do it. If you don't like it, you can go ahead and flick your nipple and scream. Or you can watch my more in-depth 30-minute analysis videos on just one company. Well, actually, you could just do both, you little freak. And nobody asked me, but I wanted to let you know I'm actually a fan of soccer. Or internationally, they call it football. And Major League Soccer just kicked off a new season. And I'd say on average, the team jerseys this year look phenomenal. My favorites based on looks are what you see on the screen. On the right is the Seattle Sounders. At first, I did not like this. However, after seeing them play on screen, it looks really, really fresh. And then on your left is Columbus Crew. This kind of reminds me of the Peanuts cartoon Charlie Brown's t-shirt, and so I like it for that reason. Alrighty, so the first company is going to be Campbell Soup Company. Campbell is a consumer packaged goods company, and they manufacture and sell canned soups, snacks, and vegetable juice produces. Their main market is North America, and their latest bet is on families eating more broth or stock-based meals in response to inflation. Campbell is also a sponsor of the MLS, which is the Major League Soccer. I am telling you right now, even if you are not a fan of soccer, when you have time today, watch highlights of Messi playing for Miami against LA Galaxy. The man is a legend for a good reason. I'm telling you, it is really entertaining. Campbell is also going to increase their top line revenue once the FTC approves their acquisition of Sovos Brands, which to me makes a lot of sense. It complements the Campbell portfolio, which includes the Prego pasta sauce. And next up is a REIT called Crown Castle, and they are in the business of managing cell phone towers and small cells in which the cell phone companies pay to utilize those assets. And if you have a phone that's capable of utilizing 5G, then you understand just how fast and efficient mobile data networks are. Unless, of course, your experience with 5G was on a crowded New York City street, then you probably think it's trash. But anywho, Crown Castle also manages fiber assets that provide an insanely fast internet experience. Fiber is changing the name of the game. Although some people would disagree with me and say Starlink is changing the name of the game for internet, but Starlink doesn't provide us fast internet speeds. Crown Castle's competitor, American Tower, despite its name, operates mostly cell phone signal towers overseas, whereas Crown Castle operates in the US. So the major clients for Crown Castle are AT&T, T-Mobile, and Verizon. And what you see on your screen right now is the market growth for cell towers from 4G to 5G. It's an industry worth billions of dollars because more and more consumers expect faster internet speeds as they scroll on TikTok for 4 hours on end. The forecast projects a 21% annual growth rate to this demand. And who's going to win? Crown Castle. And you know what? I would describe myself as being a patriotic American that's also a veteran. Some folks talk a lot of trash about the US, but I'll say this. If you've ever gone on a long road trip or done a cross-country drive, you'll quickly realize just how beautiful America is. And sure, we do have our own problems. However, the mountains, the trees, the lakes, the rivers, etc. When you're driving through the middle of nowhere in Wyoming and you have cell phone signal, that's thanks to Crown Castle. When you have cell phone service at a national park or at a restaurant, that's because of Crown Castle. And the reason why I'm bullish on Crown Castle is because when you take into consideration the addressable market and target demographic, what you see on your screen right now, the US is the most ideal customer base for cell phone mobile data. Not only do Americans consume more mobile data per month than any other country, but they also spend much more to get those faster speeds. Next up is General Mills. They're much more than what you see in the cereal aisle. General Mills actually dominates the grocery store because if you look on any aisle, you will see one of their products. And historically, their main bread and butter was cereal. However, their cereal business is not thriving because, as it turns out, a lot of the boomers and older population, alongside with Gen Z and the new kids, they do not like cereal because they understand how unhealthy it can be. But the funny thing is, milk and cereal is still very popular and resonates with the millennials, which I am one. So in light of that, General Mills is making a fast pivot to be the go-to brand for pet foods and treats. Essentially, General Mills is in the business of producing foods that people and pets eat. Their iconic brands include Blue Buffalo, Bugles, Cheerios, Chex Mix, Cocoa Puffs, Cinnamon Toast Crunch, Haagen-Dazs ice cream, Pillsbury, and Yoplait. If you lived through the 90s, then you understand how much brand recognition their portfolio has, which includes over 100 different products and brands. I took a look at their balance sheet and things are looking a little slow. The company is in a period of flat growth, but their balance sheet is very solid and they are laser focused on returning gains for the shareholders, which as a dividend investor is important. However, I would rather see them growing again at a mid to high single digit number. Regardless, they're paying a healthy dividend that's sustainable and they're buying back shares in the meantime. Now let's go ahead and talk about Hormel. Hormel is in the business of protein. So for you athletes and in general, people who work out, their foods are important for the gains. supplements. If you want to recover faster and see muscle progress, protein is important to be a part of your diet. Jokes aside, Hormel is in the business of canned food, turkey meat, bacon, and peanut butter, as you should see Skippy on your screen. And I'd even argue that Hormel is the much better alternative to Kraft Heinz. And I want to call this out because it's important. Hormel has a long history of consistent dividend growth, 57 years, through the ups and the downs, even through the dot-com bubble, the Great Recession, and the pandemic. Hormel also has strong fundamentals on their balance sheet, although last year wasn't too hot. Because of their finances and balance sheet, their trading multiple is a little higher than their industry peers. So Hormel has a modest PE ratio of about 21. In contrast, Kraft Heinz has a PE ratio of 15, and Campbell is around a 16 PE ratio. And last but not least, Marriott Vacation Worldwide. Ticker symbol VAC, VAC, vacation, right? Not one person talks about this company, and I actually found it by mistake. When I went through their balance sheet and looked at their income statement, my goodness, what a hidden gem. They are basically in the business of timeshares, except on a points system. Their customer base is the top 1% of Americans because the customer has to pay an annual fee to be a part of the vacation club. And that annual fee is in the thousands of dollars. So their business model is similar to Costco, in which Costco actually generates their free cash flow from the membership subscription fees. As a member of Marriott Vacation Club, you'll be able to book an accommodation at one of their portfolio of resorts. So instead of paying all the money towards a second home that you only use every so often, the vacation clubs such as Marriott are a way to just enjoy the vacation home without the ownership hassles. Does that make sense? And that's part of their pitch. Each resort location has a full staff and team taking care of all the details, such as cooking, cleaning, providing activities to do. And these timeshare mansions and resorts are usually located in areas that people would describe as paradise, or where retired folk would like to golf. And the best part is, if you're going to Hawaii in a particular year, you can rent a timeshare in that area. If you're going to Disney World, you can rent one in Florida. And I want to say this up front. On a personal level, I do not like them. And that's because I do not agree with their business model. Once you sign up to be a part of their timeshare program, you're locked in for life, unless you can sell off your membership to someone else. That means you're going to have to pay that annual fee every single year until you die. And not only that, you also have to pay annual maintenance fees on top of that membership fees in order for the properties to be taken care of. And the reservation process is done on a points system. From what I read, you have to book as far as 13 months in advance to get the dates and location that you want. So for instance, a studio room will cost about 1,000 points. But if you want to stay in a 4-bedroom accommodation, then it's going to be like 9,000 points. And based on your membership tier, you get a certain amount of points every year that can roll over to the next year, so that you can stack your weeks of vacation like 3 years out. That's what you're buying, vacation points, and to be a part of the vacation club. It's a little different from a traditional timeshare. However, 87% of their EBITDA contribution are from people buying into the vacation club, that subscription fee. The other 13% are from folks who bought memberships from a global vacation club such as Interval International. If all of that was confusing, just think of Marriott Vacation Worldwide as a glorified hotel program, and their balance sheet looking great because it's similar to Costco's membership subscription fee. Now let's go ahead and take a look at their dividend profile and history. First up is going to be Campbell Soup Company. Their dividend yield is sitting at 3.4%. Their dividend payout ratio is 55%. And their annual dividend payout is $1.48. And when you take these three factors into consideration, it means this dividend yield is pretty much sustainable. It's a very low payout ratio, and they are growing this dividend at a rate of 1.8% year over year. So in 2015, Campbell paid out $1.24 a share in dividends. You fast forward in 2023, their dividend payout is now $1.48. Did you know that goldfish is actually a part of the Campbell Soup Company portfolio? I love that snack. Genuinely. As a dividend growth investor, you want to see a company at least growing that dividend payout at the rate of inflation or better, meaning at around 3.5% or higher. And to see Campbell growing it at 1.8% is a little disappointing. And then we have Crown Castle, the cell phone tower REIT company. Their dividend yield is actually quite juicy at 5.7%. They pay out $6.26 annually, and the payout ratio is 85%. It's a little high, and that's because their stock price has been in the cage with Conor McGregor, and it's just been beaten up, so it's pretty low right now. I think they're near their 52-week low. However, as the stock price recovers, their payout ratio should be around 65% to maybe 75%. And Crown Castle is growing their dividend at a rate of 8.2% year over year. So in 2015, they paid out $3.24 a share. You fast forward throughout the years, and now they pay $6.26 a share. That's amazing. That's what you want to see as a dividend growth investor. And now General Mills. Their dividend yield is 3.6%, which means they pay out $2.36 a year. The dividend payout ratio is 57%, and they're growing this payout by 4.5% year over year. So as a dividend investor, General Mills hits the mark as to what we are looking for in their dividend profile. Oh, by the way, in 2015, they paid out $1.76 a share. You fast forward throughout the years, now it's $2.36. Let's talk about Hormel. Their dividend yield is 3.7%. Their dividend payout ratio is 77%, and I know the color is red, but I don't think it's that high. For a mature company, I think it's okay. For instance, if their payout ratio was hovering at around 90% or above, then I would say it's in the dangerous category. They have been increasing their dividend for 58 years. Some of you aren't even 58 years old. They've been increasing this dividend longer than you've been alive. And they're growing their dividend at a rate of 5.7%. So in 2015, they paid out $1 per share in dividends. And the reason why this number is low in 2023 is because back in 2016, Hormel implemented a 2-for-1 stock split. So if we do reverse math, their dividend payout should realistically be $2.20 in 2023 if that stock split never happened. And lastly, Marriott Vacation Worldwide. Their dividend yield is 3.2%. Their dividend payout ratio is 48%. In 2015, they paid out $1 per share in dividends. And you fast forward to 2023 and they paid out $2.88 last year. However, if you notice, there's a huge blank right here, and that's because Marriott actually cut their dividend during the pandemic to preserve their business. And they came out of it okay because they reinstated the dividend almost right away. But I want you to keep that in mind because they did in fact get rid of their dividend altogether for about a year. Not you or me or Oprah Winfrey can predict the future. These companies and stocks could go bankrupt by the end of the year. All we can rely on as dividend growth investors is their past performance and how they sailed through the storm. Did they navigate through tough times before, and what were the outcomes? First up to judgment is going to be the Campbell Soup Company. So with $10,000 invested on January 1st, 2014, and reinvesting all the dividends back into the portfolio, the final balance 10 years later would have been $13,900. That's a CAGR of 3.3% year over year, meaning that's how much they grew year over year. During their best year, which is 2019, they grew by 55%. And during their worst year, which was 2018, they went down by negative 29%. And then we have Crown Castle. With $10,000 invested on the exact same timeline of January 1st, 2014, and 10 years later, that final balance would be $21,000. Their CAGR is 7.8%. During their best year, they went up by 35%. And during their worst year, they went down by negative 32%. $21,000 from $10,000. You love to see it. And now it's General Mills. $10,000 turns into $18,000 in 10 years. Their CAGR, 6.2%. Their best year, they went up by 43% prior to the pandemic. Their worst year, they went down by negative 31%. And now it's Hormel with $10,000. 10 years later, the final balance would have been 16.5 grand. This spits out a CAGR of 5.1%. During their best year, they went up by 54% back in 2015. However, during their worst year, which was last year, they went down by negative 27%. stocks. And now Marriott Vacation. Same timeline, $10,000 would have been 18.3 grand. This spits out a CAGR of 6.1% during their best year. Oh my goodness, prior to the pandemic, they went up by 85%. During their worst year, they went down by negative 47%, which is really surprising to me because I would assumed back in 2020 they should have been obliterated, but in fact, they were actually in the green. And this wouldn't be a proper dividend investing video if I didn't rank them, right? So when it comes to the dividend stocks nobody is talking about, I actually rank them against each other like it's an Amazon employee performance review. I truly believe out of these 5 companies, Crown Castle is undervalued, underrated, and underappreciated. I think General Mills has a promising recovery story since the executive leadership team is acquiring the right brands and making a pivot from only relying on their declining cereal business. Hormel looked like a pair of pepperoni nipples on a man's chest. It looks okay. It's not fantastic nor disgusting. As for Marriott, their balance sheet and business model is superior to all the others on this list. However, when the going gets tough, they might cut their dividend again. But realistically, can you fault them? During the pandemic lockdowns, nobody was allowed to travel at one point, which is essential for their business to thrive. Will there be another pandemic in the future that will disrupt their business model? Probably not. If they didn't cut the dividend a few years ago, Marriott would easily have been ranked higher on this list. And last but not least, who let Campbell Soup Company sneak onto this list? This is the definition of an average dividend company. Absolutely nothing special about this stock. With limited stock growth, I see Campbell as like a high yield savings account, spitting out about a 3.5% dividend yield. So there you have it. I thought some of these companies were hidden gems. Maybe they're underrated for good reason. Maybe these companies are too old and their futures look weak. Who knows? One thing is for sure, none of these companies have the spotlight or media attention. And if you enjoyed this video, please do me a solid and click like. Please, I put a lot of time and effort into it. And with all things considered, I'm out of here. It's about time I go get a sweaty workout in. So good morning, good afternoon, and good night. I'll talk to you next time. Dividend Compounders with Cheese, signing off.